Once again, we have joined you online, and we want to get the feel of online lectures to you. That's not the reason. But Indigo, you know, the whole India is going through a turbulent time, and I think air turbulent happens only in the air, but turbulent with Indigo happens on the ground also. That's the reason we are here online today, and it's indeed a pleasure to have you with us. And now, let me briefly tell you what's happening in the next few days. On the 11th, we have the NTC PC quiz, the national quiz is happening at MMA. Then on the 12th of Feb, we have got Mr. Amitabh Kant. He's going to be talking to us, delivering the 7th R.K. Swamy Memorial Lecture, Road to the 30 Trillion Economy by 2047. That's happening on 12th at MMA Management Center. Luckily, he's traveling by Air India, so you will be there. So not to worry, this will happen. And on 18th of December, we have Read and Grow. It's for the students. The book what we have chosen this time is The Compound Effect of Jumpstart Your Income, Your Life, Your Success by Dream by Darren Hardy is the book, and it's a lovely book. And please do come on the 18th of December. Is happening at MMA. Then on the 12th of December, again we have a conclave on this. We are doing jointly with GLIM, leveraging low cost, high impact innovation. This is a Toyota model. The discussion where Professor Vivek has written a paper. We are going to have a discussion. This is happening from 10 to 12:30, half a day conclave. Toyota model, very, very interesting for a manufacturing sector. Then on the 12th, we just got confirmed with the Kanwal Ricky, founder of TAI USA. He is visiting Chennai, and we are doing a joint program along with the TAI Chennai on 12th of January at MMA Management Center. Then on 19th of January, we have again a talk from Lucknow to Wall Street. Leadership lessons from building a global research powerhouse. We have got Miss Devina Mishra. She's the founder and CMD of First Global. She is coming to India, and she'll be joining us on 19th of January. Then on 30th January, you have again book launch by Dr. Mridula Ramesh, who is going to be from Madurai, will be joining us. Then 2nd Feb, we have again event jointly with GLIM. Dr. Vijay Govindarajan, Distinguished Professor of Tuck University, he is going to be talking about innovation. Vijay Govindarajan. Then again on 7th of February, you have another interesting event by Vidya Shankar Chakravarti. He is a founder of Lilly Foundation. He will be talking on a very interesting subject of health. You can hear us navigating societal fault lines within children. So that is happening on thing. On the 11th, our flagship event, MMA Annual Convention 2026, India at 2035, driving progress in a changing global paradigm. So this is what is happening. Few things, there are a number of other events. I'm not skipping. Now we want to start on time because we all come to listen to one of the finest thing in the area of monetary policy and Reserve Bank and so many control what's happening. Indeed, this event today is a lot of excitement. A lot of people want to come to MMA and really meet him. But unfortunately, we couldn't do that. And he assured us to come next opportunity visiting Chennai. He will really agree to address the members. Coming to today's topic, monetary policy, inflation, and financial stability, balancing the trilemma. And as usual, all the viewers watching this program on all our social media portals, webinar, LinkedIn, YouTube, Facebook, Twitter, and also Voice of MMA, please send your question to us, and we'll be more than happy to address all your questions. Now, to commence with, we'll have a formal welcome address by our Managing Committee member, Mr. Vijay Kumar. Thereafter, opening remark by Mr. Kumaraswamy, and thereafter address by the speaker. Then there'll be a brief conversation between the speaker, Lokeshwarri Madam, and Kumaraswamy. Then all the questions what have been put as well as chat box, as well as what has come online will be taken. I only request the people who are joined online to put questions what is relevant. We don't want any conversation between them and between. I've seen most of the time one question by one of the participant, other participant will respond. Please not do that actually. And I'll really appreciate your understanding on this. And now coming to thing, let me have the privilege of welcoming Mr. Vijay Kumar to deliver the formal welcome address. Vijay Kumar is a member of the MMA Managing Committee, Executive Director and Group CFO of Sifi Technologies, and he's also been instrumental in shaping the company and the enterprises of infrastructure and service. He serves on the board of prominent organizations, including LIC, Heritage Foods, Geochit Securities, Opal, and many more companies. I now request Mr. Vijay Kumar deliver the formal welcome address. Over to you, Mr. Vijay Kumar.
Yes. Thank you, Captain Vijay Kumar. Good evening to all. Good evening to all, and it is indeed my privilege to deliver the welcome and introductory remarks at this very special online discussion on the theme monetary policy, inflation, and financial stability. Balancing with Trilemma, organized by MMA in association with IMA, Aluminum Association, with support from KAS. It's my pleasure and privilege to welcome this evening Dr. Ravindra H. Dholakia, Director, Central Board of Reserve Bank of India. Thank you, sir, for accepting our invite and joining us today. It's our loss that we are not able to interact with you in person, but as Captain Vijay Kumar said, hopefully sometime soon we'll have the opportunity of interacting in person. Ms. Kumaraswamy, author, columnist, and consultant, and a seasoned finance professional. Ms. Lokeshwarri SK, Senior Associate Editor and Head of Data Vertical from Hindu Business Line. I take this opportunity to welcome all the members of MMA and IMA, our guests from other organizations, and all the participants who have joined us online. For the benefit of the guests and invitees online from various organizations, I'll just take a minute to take the pleasure of informing that MMA was established in 1956, the year in which the Companies Act also had its origin post-independence, has evolved today as the largest management association in the country, with over 8,000 members spread across 12 chapters in Tamil Nadu and Pondicherry. MMA has been awarded the best management association in the country for 15 times in a row, including the preceding year 2024-25. The interconnection between monetary policy, inflation, and financial stability is one of the most important and complex relationships in modern macroeconomics. Central banks are expected to constantly monitor the dynamics and balance these three vital parameters of a nation's economy, which often tend to counterbalance the other. In India, the relationship between these three has been shaped very effectively over time by the Reserve Bank of India. Liberal policy measures impinging on low rates and quantitative easing stimulates demand and prevents deflation. But when prolonged, it encourages excessive risk-taking. This risk-taking channel means that keeping inflation at target for years can quietly build dangerous financial imbalances. These days, we see central banks all over the world face a difficult trade-off. Focusing solely on short-term inflation control tends to sow the seeds of future financial crisis, while prioritizing financial stability sometimes requires tolerating temporary deviations from the inflation target. In practice, achieving both low, stable inflation and lasting financial stability simultaneously remains one of the toughest challenges in modern central banking. We are indeed fortunate to have amongst us this evening Dr. Dholakia, who has vast experience at the policy-making level, having served across several high-level government committees, including pay commissions, public expenditure management, financial sector statistics group, and state-level fiscal reform panels. We are delighted that Ms. Lokeshwarri and Mr. Kumaraswamy, who have studied and analyzed these issues for years, have joined this evening for a conversation with him. I once again thank my colleagues from the Managing Committee, members of MMA, distinguished invitees of MMA, Captain Vijay Kumar, who very ably helms the affairs of MMA, and partner organizations who have joined us today, and viewers from all over the globe watching the program live. Wishing you all a great evening, and over to you, Captain Vijay Kumar.
Thank you, Mr. Vijay, for your kind words and the warm welcome address. And before we proceed, let me remind you all, people who are watching various channels, that Mr. Kumaraswamy will set the context, opening remarks. Thereafter, The chief guest for the day, Mr. Ravindra Dholakia, will address his speech on the theme of the evening. Thereafter, there will be a conversation between Mr. Dholakia, Mr. Kumaraswamy, and Lokeshwarri. Then thereafter, we'll take the questions what has come on line here, the Zoom, as well as those who have come from various social media portals. Before I request Mr. Kumaraswamy to deliver the formal opening remarks, let me have the privilege of introducing all the three speakers. May I have the AV, please?
Dr. Ravindra H. Dholakia, Director on the Central Board of the RBI, is a distinguished economist with over 45 years of academic, research, and policy experience, including a long tenure at IIM Ahmedabad. A former member of India's first Monetary Policy Committee, Dr. Ravindra Dholakia has contributed to numerous high-level government committees and international agencies across areas of macroeconomic policy, development, labor, health, education, and public finance. An acclaimed scholar with extensive publications and consultancy work, Dr. Ravindra Dholakia has also served as an independent director on several major corporate and public sector boards. Ms. Lokeshwarri, Senior Associate Editor and Head of the Data Vertical at the Hindu Business Line, leads a data analytics team and writes the fortnightly point-blank column on markets, policy, and the macroeconomy. With nearly 3 decades of experience spanning media and finance, Ms. Lokeshwarri is known for her expertise in market analysis, data journalism, and editorial leadership. A recipient of the Shriram Sanlam Award for Journalism, Ms. Lokeshwarri is committed to delivering insightful, data-driven content that helps readers understand complex economic issues. Mr. V. Kumaraswamy, an author, columnist, and consultant, is an IIM Ahmedabad alumnus whose industry experience across remote regions in India and abroad shapes his unconventional insights on economic and policy issues. Mr. Kumaraswamy, a longtime contributor to Business Line and Business Standard, he has written extensively on reforms and development. Mr. Kumaraswamy is also the author of 3 books, Making Growth Happen in India, Weird Adventures and Uncommon Lessons, and Unsung Heroes, along with over 100 articles and several poems.
Ladies and gentlemen, I think we have such a privilege to have such a high-profile speaker and the panel to discuss on a very, very important, relevant theme today. Over to Mr. Kumaraswamy to take it forward. Mr. Kumaraswamy.
Thank you so much, Group Captain Vijay Kumarji. I think that was AI reading, is it? As Professor Dholakia's name is.
Dholakia kar diya.
Yeah, that's right. Good evening, all. And my intro will take about 7 minutes, where I'll talk about the challenges as well as a little more about Professor Dholakia. Actually, we are fortunate to have him, and we should have had him physically, but for the goings-on in Indigo. And incidentally, he was on the board of Air India, and he, along with Dr. Gosharan Das, was primarily responsible through their oversight of through the independent directorships, convinced the government to sell off. And that was, very pretty close monitoring through their independent directorships. I wonder if the goings-on in Indigo would have happened if a similar oversight was provided in Indigo's board also. I have had the benefit of the mentorship, I should call it, a professor without being a student of his. He joined IIM later. I happened to meet him during one of the meetings of Dr. Ashish Nanda, who became the director. And I met him in one of his parties and somehow struck a card. And almost 12, 13 years later, we have been maintaining our conversations, and it has been of immense benefit to me. Although I don't know what he gets out of it, but I have been immense beneficiary of this association. His commitment to the students is total, you won't believe it. Recently, I completed my PhD, hardly a month old, And although he is not a formal member of my TAC, I had sent my thesis to him, and knowing fully well he was in US or Canada at that time with his grandchildren. And 30, 40 days, no response. And I thought perhaps I overreached. And suddenly comes the papers completely with even spelling mistakes and grammatical errors corrected. And one serious flaw in one of the innocuous looking graphs getting pointed out. It took about 2 or 3 days for me to even understand the question. After that, I had a call with him. He kept on saying, you are not very clear conceptually. You are not very clear conceptually. Define y-axis for yourself first and then to me. Then you can convince me. Although it was a little deflating at that time, it took about 6-7 days for me to understand what he's saying and a further 45 days to correct it. But I tell you, it gave a completely new dimension to my thesis, leading to the mathematical formulation of what I was saying. Thank you, Professor, for that insightful, what should I say, almost a reprimanding kind of comment, which you just wouldn't give up. Yeah, that was great. Very foresightful, and just smelling it wrong is fantastic. A truly remarkable mentor for whom mentees' progress seems to be the only reward. Despite his seriously forthright nature, he balances things, opinion with facts, theoretical concepts with grounded practice. His shoes are dirty, as they say, because it's soaked in reality at the ground level. And having been in so many committees and practical, with practical knowledge, but his head is very, very conceptually clear. And fortunately, we have 2 or 3 more people attending our conference today who are of a similar genre. That is Dr. Bhanumurthy and Dr. Suresh Babu from MIDS. Dr. Bhanumurthy is the director of Madras School of Economics, and Dr. Suresh Babu of MIDS. And I hope Chennai makes the best use of them while they are here, because the center of gravity for these people is obviously Delhi. You either go to the Planning Commission, Niti Aayog, or ICRIAR or something. So please make the best use of them while they are here. I also see Dr. Charan Singh, ex-RBI and current chairman of EGRO, another website which hosts leading economists in chat shows. Thank you, Dr. Singh. Incidentally, I don't know about Charan, I think he is from New Zealand, PhD. Incidentally, if with a tongue-in-cheek I can make a remark, none of them are from JNU. May you live in interesting times is a Chinese proverb which has got exported everywhere, and as ubiquitous as their Manchurian and noodles now. And I've yet to figure out though what is the meaning, whether it is a blessing or a curse. But we live in such times now. It started with COVID, where once again Chinese proved that whatever they do it on world scale, nothing else, nothing less. And followed by a succession of wars which seem to be never-ending. And Trump's tariffs, which is the only thing which defies gravity. It defies gravity of understanding as well. As if this is not enough, in the last about 10 days, Japan's meltdown has started. US has started genuflecting to Venezuela, if you are following the stories. If Nixon nixed conversion of dollar into gold, it looks like US is trending towards a situation where it will not be able to convert dollars for dollars. I don't think they will be even able to raise enough debt to repay their maturing debt. In all this midst, India maintains sanity with a combo of high growth and low inflation. And if we do maintain this kind of combo for next 6-7 quarters, maybe many macroeconomic theories may need to be revisited. To help us understand, figure out the complex web of financial stability, inflation targeting, and monetary policy, we have Professor Dholakia. He has been a member of various committees of the government, both at the central and state level. He was also in the 6th Pay Commission. He was a member of the first Monetary Policy Committee, and he has been a director on GSFC, NCDX, Power Finance Corporation, State Trading Corporation, Air India, Union Bank, and several other things. Of course, recently, he is a director in RBI and NABARD for the last 2 or 3 years, where this one have been immense. And he's also worked as consultant with organizations like WHO, UNICEF, World Bank, UNDP, Hewlett Foundation, United Nations, UN Mongolia, etc. Besides all this, of course, is a professor. He has guided 41 students to their PhD. He has 49 monographs, 23 books, more than 140 research articles. I am talking about the same person, not different people. So huge, humongous achievement for his time. And thanks the ever so efficient Vijay Kumarji for facilitating this, and also to the other Vijay Kumar for the excellent introduction. And Ms. Lokeshwarri, she's an exception among the current day reporters. No razzmatazz and unwanted, detours. Straightforward, incisive analysis of comments and about the economy and financial world, which is very good to read. Thanks, Lokeshwarri ji, for accepting my suggestion to be on the panel. The plan will be as follows. Professor will speak for about 35 minutes. After that, the MMA's main customers are the audience. So we'll give the preference of the first question to the audience, followed by Lokeshwarri ji and then me. We'll do it through 2 rounds, and after that, throw it open to the audience completely. Thanks, and Professor Dholakia, we are here to hear you.
Thank you very much for all the introduction and this opportunity to address a very wide, qualified audience, very keenly interested and obviously a very relevant kind of audience for the topic, namely the monetary policy, inflation, and financial stability. The tag is important, managing the trilemma. Because the trilemma is basically a question about, in theory, the trilemma occurs when you have a fixed exchange rate, which leads to the financial stability. When you have the capital account convertibility, in the sense that there is a free flow of capital, international capital, and then there is a independent monetary policy. These 3 things together is considered an impossibility. So it is an impossible kind of achievement. Having a fixed exchange rate, open capital account, and the independent monetary policy, it was shown by a Nobel laureate that this is not likely to be achieved. That is why it is called trilemma. Now, I'm not saying that we are managing trilemma at all. We are into this trilemma. We are facing this trilemma all the time. My basic purpose in this 30 minutes or 35 minutes that I am supposed to speak to begin with is that let me just chart out what exactly has been the logic or what has been the philosophy or ideology behind this kind of effectiveness of monetary policy. Okay, that is, monetary policy is considered effective and all that. There is a huge debate about this in the literature. In the long run, monetary policy is not supposed to be effective at all. But in the short run, it makes a sense. Now, I would rather briefly point out and briefly chart out what exactly is the logic. And then I will definitely take this opportunity to voice my serious concerns about this framework. Because it is unfortunate that we have practically adopted this framework without questioning and without really trying to modify it to suit our economy. I think that is something which I have been throughout in my, as Kumaraswamy said, whatever, writings, etc., that I have been making, and particularly of recent origin after 2016, you will find that I have been always questioning, and I am always onto this kind of things, that somehow we are missing out the basic essence. So let me start with this. What is the current logic? This is derived from the Western countries, basically from the developed countries standpoint. Now, what is the developed country? Please understand one thing. Developed country is a stagnant economy. Is a stagnant economy in the sense that urbanization is at the peak. Nothing changes there. The structure of the employment is practically the same between primary, secondary, and tertiary sector. It is more or less the same. It is a stagnant thing. The growth rate is typically in the range of 1 and 2%. If you consider the real growth, it is again 1.5%, 1 to 1.5%. That is the kind of growth that you are talking about. Inflation rate is about 2%, 2.5%, depends on this. But this is the kind of the characteristics of the developed countries. We, on the other hand, and I'm very categorically mentioning this because very many people very enthusiastically adopt those theories and those frameworks which are essentially meant for the developed countries. The developed countries, as I defined, were with these features. Okay. Our country, on the other hand, is a complete dynamic economy. It's a complete dynamic economy. Everything keeps changing. Like, say, for instance, urbanization is at a very fast rate and it is increasing. It is increasing. It is we were 31% of the urban areas in 2011. By now, people are talking about 35%, but I believe that we are close to 40% by now. And we are likely to be very, very rapidly growing, because once you cross 30% of urbanization, the growth of urban areas is phenomenal. And again, we are not properly capturing the urban area as per the definition in the census. Our measurement itself is faulty. Okay, that itself. I'm not talking about the concept. Concept is correct, but the measurement is not correct. It is not reflecting the same thing. So anyway, what I'm saying is that there is something which is expanding very rapidly. Simultaneously, we find that there is a tremendous kind of the structural shifts taking place in the employment structure, in the capital structure, in the infrastructure development. You name the thing, and you find that the things are moving at an unprecedentedly fast rate. We are experiencing that rate of technological progress which is unparalleled to the rest of the world. I think it is beyond question. Therefore, our growth is no longer in terms of 1 and 2%. Our growth in real terms, even under these kind of circumstances, it is about 6.5% to 7%, whereas our potential is likely to be around 8 to 8.5%. And if therefore we are clocking 8.2% during the last quarter, I am not surprised. We are only nearing our target, our potential. That is the kind of a thing. As far as the inflation is concerned, inflation is typically around 4 to 5% or maybe more, marginally more. If you take the trend rate, it is likely to be 4.5 to 5%. But the question is that our inflation is again not 2% and 2.5%. It is also more. Therefore, I think when we consider these kind of things, please keep these things at the back of your mind, that we are talking about an economy which is completely different from the economies which are leading to this framework. The framework that I am now going to briefly talk about. The basic premises for the monetary policy, conduct of monetary policies are, and this is very relevant. One is that inflation is a demand-driven phenomenon. If inflation was supply-driven phenomenon, the monetary policy doesn't have the same kind of effectiveness, doesn't have the same relevance. So inflation is demand-driven. That is the first thing. In most of the developed countries, this is the case. Inflation is a monetary phenomenon. Another very important premise. Inflation is a monetary phenomenon. What is the meaning of that? That if I change the money supply and the liquidity in the system, it is going to result into the corresponding proportionate increase in the price level rather than any changes in the real economy in the long run. So that is the kind of thing. So inflation is predominantly a monetary phenomenon. By controlling the money supply, you can control the inflation. That is the meaning of this. Okay. So you derive the effectiveness of monetary policy through this thing. That inflation is predominantly monetary phenomenon. And the purpose of monetary policy is to control inflation. The third thing is, and this is very, very significant, the third thing is, in the long run, money is neutral. Which means that in the long run, the money cannot influence the real variables in the system. Real variables will remain the same. It is only the proportionate change in the prices that you are going to have. I think these are some of the basic premises. The implication of the third one is that if I want to disinflate, if I want to bring down the inflation rate in the long run, there are no costs involved in the long run. That means that the basic trade-off does not exist in the long run. The trade-off exists only in the short run. This is the kind of the premise, and these are the basic things which are there in the thing. And I am again just reminding that I think Raghuram Rajan, when he was the governor, and Urjit Patel, when he was the governor, these two gentlemen have stated these things explicitly in the media and everywhere else. So I am not presupposing or presuming something. This is already stated explicitly by the governors of the Reserve Bank of India. Okay. And this has been the tradition. This has been the entire thing. The whole inflation targeting framework came from these three premises. So this is important to understand. Now the question is, how do I get these three things? What is the framework? The framework is simple, very famous quantity equation. The quantity equation says that when you have price and when you multiply it with quantity, you get the expenditure, total expenditure. If you have only one item, this is the correct thing. If you have hundreds of items or thousands of items, then you find that there is something called aggregate price and there is something called aggregate quantity, and that should be equal to the aggregate expenditures, which is basically in terms of the money, you have to say that this is money supply. But it will not be money supply per se, because money does circulate. If an average unit of money circulates in the system 5 times, then you don't require 100, you require only 20, because you have to multiply it with the velocity of circulation to get 100. And that is the basic equation. Now, this is an identity. Please understand, it is true by definition of velocity. The entire framework gets developed out of this is, if you assume that velocity is constant, and if you assume that this entire equation is now converted into a dynamic form, then the equation becomes very simple. The growth of money supply is exactly equal to the inflation rate plus the growth of real income, or what is known as GDP. This is the basic thing. Therefore, what you are saying is, growth in the long run is not affected by the money, because money is neutral. Therefore, if you control the growth of money supply, you are controlling the rate of inflation. This is something which is important to realize and understand. What inflations are? Inflation in this case is the GDP deflator inflation, not the consumer price inflation. It is the GDP deflator, which means it includes everything that it gets included in the GDP. Whereas consumer price index is only those things on which consumers spend their income. Is that clear? Therefore, there is a difference. There is a distinction here, which we have introduced. We means the economists have introduced for the monetary policy to become more relevant or relevant sounding. Okay, let us be very clear. Now the point is that this is very true. This always obtains in a closed economy. The moment you open up the economy, the open economy means that capital flows in and out. When the capital starts flowing in and out, it depends on the interest rates. So if the interest rates are properly aligned in the global sense, then the flows are stabilized. And therefore, you can basically control the money supply through controlling the interest rates. It is for this reason that you find that in an open economy system, you have the interest rate as the instrument of monetary policy rather than the growth of money supply. That entire focus has changed. Nobody now talks about the growth of money supply or the money supply per se. People start talking about in interest rates. And therefore, repo rate, which is an indicative rate for the rest of the interest rate structure, you find that it is that thing which is the basic instrument for monetary policy. Now comes the trilemma kind of a thing, because, in order to ensure that the growth of money supply is kept under control and is reasonably managed, you have to manage the interest rate in such a way that there is an interest parity, and there is interest parity implies that you have to have the inflation rate parity. That means that the exchange rate, because that is the basic indicator for the financial stability. If you are talking about the financial stability, the exchange rate is an important parameter. Now, the exchange rate management would imply that you have to focus on the inflation rate parity. That is the reason why the inflation targeting becomes a very important matter in this context. The international rate of interest, that is the US rate of interest, we can say as a proxy, is about say 4 to 5%, and our rate of interest is typically about 6.5%. So there is this becomes a parity. I am not talking about equality, talking about parity. Now, Samuelson-Balassa hypothesis says that a country can afford to have a higher inflation rate provided it also has higher productivity of resources. I'm talking about total factor productivity growth. Okay. Now, a developing country invariably has, and particularly India, as I was already talking, already has a very high rate of the technological progress. Our rate of technological progress, or what you say, the total factor productivity growth, is about 2 percentage points higher than the US or the developed world. Okay. Therefore, we can afford to have a 2% higher rate of inflation compared to the developed countries. That means if they have about 2.5%, we can afford to have 4.5% rate of growth without putting any pressure on the exchange rate in the long run. Please understand, this is exactly the framework. All these frameworks will ensure that there are financial stabilities, that is, a reasonable stability of exchange rate. Then there is a reasonable inflation targeting with certain flexibilities here and there, and that there is an interest parity also. I think this is exactly how the monetary system and the monetary policy framework is supposed to be working. Now, I have some very significant and very serious concerns about this entire framework. And that is what I would rather now like to turn to. And before I complete and conclude, I have whatever concerns are there, I'll point out and then just conclude the matter. My first concern is that all these are the long-term relationships. In the short run, these things don't work. In the short run, it is only the expectations of the stakeholders which matter. So they drive these kind of things, financial stability on one hand, that is exchange rate fluctuations on one hand, the interest rate fluctuations and the inflations are all subject to largely expectations of the stakeholders. That is number one. That explains short run. But the most relevant matter is that the first premise in the entire framework is that inflation is demand driven. In India, I do not think that inflation is demand driven. Inflation is largely supply driven. This is what is my concern, that we are not somehow modifying the entire framework to do this. When I say that it is supply driven, what it means is that it is not so much the money supply and the monetary and the interest rates which are of critical significance. It is the growth rate in the system which will drive the whole thing. If the growth is high, inflation is likely to be on a lower side. If the growth is slow, the inflation on the other hand is likely to be higher. I think these are the implications of saying that inflation in India is more supply driven rather than demand driven. The second important thing is that in the long run, money is not neutral. I would sound very, very typical guy who would be thrown out of the economics profession because, the whole economics profession thinks that money is neutral in the long run. Actually, the long run that is considered in the monetary theory is not the same thing as the long run that is considered in the growth theory. In the growth theory, the long run is the steady state growth. In the short run, and in the monetary policy, the long run is defined as the trend rate of output, which is basically considered the full employment level of income. I think these are the two very different concepts because in the investments are not considered as a very important aspect of demand. They are only considered important aspect of demand. Their capacity creating role has been ignored in the monetary theory. In the growth theory, it is their capacity creating role which is the pivot. Now, when you consider the two things together, in the long run, money does have an influence on the real economic growth in the real economic variables in the system. Money is not neutral in the sense in which it is understood in the monetary theory. This is something. Now, macro policy, monetary policy cannot afford to ignore these kind of things. We are not in a theoretical plane. We are on the ground. If we are on the ground, we have to consider all these aspects very clearly. Okay. The third thing which is very important. If money was neutral, there is nothing called the threshold level of inflation. But money was not neutral. If money is not neutral, then there is something called threshold level of inflation. And threshold level of inflation, the concept itself says that it is that level of inflation which maximizes the growth. That means in the long run, if the inflation is lower than the threshold, it hurts the growth. Growth is sacrificed. If on the other hand, the inflation is higher than the threshold level of inflation, that also hurts the growth and you are sacrificing the growth. That means that if you believe in a threshold level of inflation, you have to believe in the fact that money is not neutral even in the long run. In the short run, it is not neutral, everybody knows. In the long run also, it doesn't become neutral. The moment you accept this, the basic thing is, my research shows very categorically, I have shown it with the empirical evidences and all that. This is not the time to go into that, but I'm only saying that threshold level of inflation depends on the fiscal deficit and the current account deficit on the balance of payment. These two parameters are extremely important. That means there is no unique threshold level of inflation. It all depends on the system. Now, fortunately for us, we have been managing the macroeconomy in a wonderful way where all these four parameters, namely the growth, inflation, the fiscal deficit to GDP ratio, and the current account deficit, CAD, to the GDP ratio, are also the ones where you have explicit targets. They are set by different bodies. Like, say, for instance, growth is aspirational target, is about 8.5%, given by the 2047 vision of developed India. Okay, this can happen only if you achieve 8 to 8.5% rate of growth. This is one thing. Second important thing is inflation targeting. The Lok Sabha has given the target and said that it will be 4% plus or minus 2% flexibility. Okay, but the target is 4%. This is also, given. You have fiscal deficit target, you have FRBM Act and all that, which provides you exactly what is the target in the long run. Then it is 3% of the GDP for the center and 3% for the states, put together 6% for the nation as a whole. This is the target that is given. And CAD, there is no explicit target given, but by and large, the prudence suggests that it should not exceed 2.5%. Now the question is, prudence requires you to have CAD targeted at around 2.5%. You have prudence required to target fiscal deficit at around 6%, both combined together, center and state. And then you have a growth target, which is given by the aspirational target by the PMO, saying that it is 8.5%. If these three targets are given, you cannot have independent target for the inflation. It has to be in sync with the remaining targets. All these four are interdependent. I take the liberty to say that it is not a trilemma, sir. It is a quadrille. It's a issue about four things. Only three of them can be decided independently. The fourth one automatically gets decided. If it does not happen, if the four targets are set independently and are contradictory to each other, in the sense that they are not consistent in the sense, theoretically and empirically, then the question is that you don't have macro stability. That is what I have shown in my presidential address to the Indian Econometric Society. And I'm saying that if the macroeconomic stability is not there, in the sense that the savings and investment don't match, and the employment expectation and the income expectations don't match, then please note, financial stability cannot be guaranteed. In fact, financial stability is a part of the overall macro stability. Unless the macroeconomic stability is there, you cannot have financial stability, which means that your exchange rate will go on fluctuating because you are not meeting certain targets and you are not having an equilibrating forces at work. If these are the cases, then the whole framework becomes a big question mark. Anyway, this is a separate debate. But what I would finally say about the unfortunate, very unfortunate parties of this entire monetary policy, inflation, and financial stability part is that our measurement is far from satisfactory. We are not measuring the inflation rate correctly. Our consumer inflation rate is not measured correctly. It is not. It has nothing to do with the backdated the base year. Base year has not been changed for now more than 15 years. I'm not talking about that. That is a known limitation. I'm talking about more serious matter. We are measuring the inflation with the household consumer expenditure survey and survey-based weights of different items like food, fuel, services, etc. On the other hand, our growth is measured through the weights of the same items in GDP. And just to give you the illustration of how inconsistent and how non-reconciled are the measurements, please note, in our inflation measurement, we are attaching 46% weight to the food. In our GDP calculation and growth measurement, we are attributing, we are putting only 16% weight to the food. Sir, these two don't match. That means either you are mismeasuring your growth or you are mismeasuring your inflation. The most likely error is in the inflation, not in the GDP. Because GDP data are far more reliable and far more consistent. There is no consistency check in inflation. Because the consumer survey data which are being used are typically missing out several things. Services, for instance, are completely missed out. The consumer durables are largely understated. The rich 15% richest people are not at all properly captured in the consumer survey sample. I think these are all very well-known limitations. So if you consider these things, let me just tell you what are the implications in terms of the effective. Because measurement in this country is taken very casually. The seriousness is, what is the inflation right now? The last inflation reading was 0.3%, 30 basis point. Is it clear? Sir, it is very low, extremely low, and people will get panicky if somebody says that inflation is only 0.3%. On the other hand, if I put the correct weight of the food and many other items which are derived from the national accounts rather than the household surveys, then the inflation turns out to be 1.72%. The same. So the mismeasurement is to what extent? 0.3%, 0.30% to 1.72%. What do you expect the Monetary Policy Committee to do? Can this be the basis on which any policy decision be taken? If anybody says that I have taken the decision based on these figures, I only pity them. We have to go beyond that, and therefore these numbers become meaningless. Sir, unless we do this kind of the corrections, there is no hope. I would say that we are going to commit blunders while taking the decisions, because the basis on which we take the decisions are wrong. We have to correct that at the earliest. This is the most urgent need. If you want financial stability, if you want inflation to be controlled, if you have a monetary policy which is meaningful and relevant, sir, you have to have good measurement and ignore some of this framework that I was talking about. We have to concentrate more on growth at this juncture. That is the need of the day. Thank you very much.
Yeah, unmute yourself, Mr. Kumaraswamy.
Yes, okay. Thanks, Professor, for that brilliant exposition of the various facets of the economy, which have to be managed in a synchronized fashion. That is fiscal deficit, CAD, growth, and inflation. And I really hope that with the measurement concerns that you had raised, that even if somebody is attempting to manage them in a synchronized fashion, they are indeed measuring and they are indeed managing the actual stuff rather than some apparitions. That's this one. And of course, thanks also for pointing out the differences between an advanced economy and the rather dynamic, growth-oriented economies like India, which might require some tweaking in the various policies. And it is also good to note that our TFP is very high compared to the advanced economies, and that gives us, that tells us that we can afford more inflation. And obviously, we have to target an inflation which is a lot more than the advanced economies. And I'm sure people in the position to manage things are listening to you and calibrating their responses properly. And of course, the last is a very serious matter. Measurement of various things is not that much in India correct or appropriate. In fact, it is perhaps one of the rare countries which have advanced estimates, advanced revised estimates, and then second estimates and first estimates. I mean, I don't know how many such estimates are there. I don't think this kind of thing happens in many other economies. Thank you so much. And what we will do is we will take one question from the audience because they are our prime customers. We'll begin with them and then I'll go on to Lokeshwarri ji. Any question? I can't see any question here.
There's no questions.
Panel.
We have got a lot of questions online.
Okay, well, you can start with...
Yes, sir. I mean, one of the questions that come, what you just now spoke about it, sir. It's a question from Shankar from Chennai. Based on your work with leading national statistical committees, what improvements in India's data and statistical infrastructure are most critical for enhancing the quality of monetary and microeconomics policy makings, in your perception?
Well, let me be very clear. We have to take our data gathering and data generation, because data, you have to generate estimates of inflation, you have to generate estimates of the GDP, you have to generate the estimates of consumption, you have to generate the estimates of investment, savings, and so many other things. Please note, it is an industry in itself. Right now, it is all in the public sector. And the government is doing this job in a meticulous way, trying to adhere to the international standards and trying to do that However, we are lacking in certain kind of certain kind of seriousness about it. The data, for instance, is not mandated to be provided in a timely fashion. As a result, what happens is that the agencies which are responsible with doing these things are not in a position to get these things. I mean, Kumaraswamy said that there are so many different kind of advance estimates and first revised estimates and second revised estimates and so on and so forth. This happens because the responses come very late, and there is nothing, no mandated things are there. So it is all free for all. People provide this information at their will, and when they default, then nothing happens. This is one important concern that I have as the participants. I think we have to be also responsible. Number two, I think there are serious efforts to update the base year. Unfortunately, the base year was supposed to be revised from 11-12 to 16-17. But 16-17 was an year where there were serious kind of changes, like say, for instance, demonetization occurred and the introduction of the GST occurred. As a result, the system got destabilized. You cannot have selected 16-17 or 17-18 as the base year at all, because it would not have represented anything. 19-20 was supposed to be another year, but then you had COVID. And COVID destabilized the whole thing for 2 years. Therefore, now we are stuck with 2022-23, and that is exactly the base we are now trying to do, because we are trying to find out whether it is 2022-23 is the right year or 2023-24 is the right year. That is the reason why. But we are doing it. Now, unfortunate part is, these things are very special to India, and we cannot ask the IMF to make any exception for a country. A country cannot have the exception. They will give the rating, but they will make observations. And they have made the observation that otherwise the things are good, except this problem of the base year revision. So base year revision is a serious issue. If I were in IMF, I would have pointed out this basic inconsistency between inflation measurement and growth measurement. And I would have punished the country for this. Unfortunately, IMF has not done that. IMF has not raised this issue. They should have raised this issue.
Thank you, sir.
Now, Lokeshwarri ji.
Very, very interesting and enriching discussion, Dr. Dholakia. Thank you so much. I'd like to ask you that since 2017, when the flexible inflation targeting regime was introduced in the country, the inflation 16, yeah. So inflation has been rather under control. The volatility has kind of come down, is what we have been observing, maybe because of other reasons as well. And most central banks are now talking mainly about price stability rather than growth. They go first after price stability. But now you're saying that, but given all these, the way the problems with the whole, the structure of this FIT regime itself, you're saying it's better to look at growth. So what are the changes that you suggest that should be done? But do you think FIT is a good idea? Should we continue with it? But what changes need to be done so that we can go forward with it? Because it seems to be helping the country, isn't it, in some way?
Absolutely, absolutely. So on the face of it, I would say FIT is not a bad thing at all for the country. In fact, it was a very, very important economic policy reform that the IMF and World Bank both recognized at that time as the second most relevant reform after GST. So they said the GST introduction was the most relevant reform. The second reform was inflation targeting, flexible inflation targeting. And that is how we were rated higher in terms of the economic policy reforms and all that. This is important. I'm not against inflation targeting in that sense of the term, but as I said, what you need to do is put all the 4 targets together, work out a a synchronized, collaborative kind of an effort to set different targets for different purposes. I think you cannot have 8% growth with 4% inflation. It is impossible. With the remaining two, the fiscal deficit and the CAD target to be around 2.5%, and for in fiscal deficit around 6%, you cannot have the target of 4% inflation to achieve 8% rate of growth. Out of question. Now, if you do these things, you are destabilizing the system. I mean, who is going to listen to that? The unfortunate part is that when you do the data analysis is based on the wrong measurements. So even that is not helping you. With the wrong measurements, my estimate of threshold inflation was turning out to be 5.4%. If I correct for the measurement, very back on the envelope kind of a thing, then it will turn out to be around 4.8% inflation, correct? That is the type of target that I would do. So if I have to now revise the inflation targeting, which is due in March 2026, it will be revised again. But at that time, again, we'll be talking about the bandwagon. That, you know, if I change the target, I'll lose the customers and investment. That is not the concern. The concern is what is the right kind of target. The right kind of target for me, I would rather say, rather than a target, I would put a band. Of a small band, 4 to 5% is the inflation target, with a tolerance band of 3 to 6%. So if you are asking me what would I do under these circumstances, this is what I would do.
Let me give precedence to.
I'm not
Lokeshwarri,
sure.
do you have any?
Yeah.
No, that's enough. Thank you so much.
Let me give precedence to Dr. Charan Singh now.
Dr. Charan Singh, you can unmute yourself and put on the video. Yes, sir. Thank you. Go ahead, sir. You can unmute, please. Yes.
Listening to Dr. Dholakia, always a pleasure. A clear, absolutely clear strategy, a very clear thought. Dr. Dholakia, I totally support your view, except a minor tweak. The inflation target regime is now totally for review. If we are, and you are so correct in mentioning, achieving a 8% to 8.5% potential growth that we have, we'll never be able to achieve with the 4% target. You are so correct. My thought was, this Viksit Bharat has been introduced by the Prime Minister only by 2025. Now, though he has been talking about it for about a year, the inflation target predates this. And inflation target, as you rightly mentioned, was celebrated by the IMF. And anything which is celebrated by the IMF, I'm not always sure is good for us. Right? So my view would be, and going by your own research and going by my own little research, I would say 5 to 7% inflation target, the band, would be better, because you found in your research the threshold level of 5.5%. And I looked at a 30-year average and found that 6% is where the inflation galvanizes. In a young demographic India, with only 20-year window available to do whatever we want to do with our young demographic, we don't have too long a time. IMF has been here for 75 years, will be there for next 75 years. We'll please the IMF after 2047 that we have come back to your inflation target of 2% or 3%. But I think right now, our focus should be our youth. And we cannot strangulate growth. Now, quite a bit, I understand people here understand economics. My understanding is we have already done sacrifice ratio of 3% per year. That's not what we can afford. We cannot afford for the next 20 years. We are just lucky that our former governor is now the Prime Minister's advisor. If we are able to convince him that, well, there is nothing to be excited or thrilled by saying our inflation is 0.25%. We are not a stagnant developed economy. There's nothing to be thrilled with it. I don't mind if everybody gets a job, but my inflation is 6%. Even that is a tolerable band. Just wanted to add this. And Professor Dholakia, I'm sure you are going to agree with that observation. Thank you so much.
I'll agree with a very, very clear caveat that, I have been talking about remeasuring the inflation in a correct way. The moment you remeasure the inflation in a correct way, 6% will not sound 6%, 5.5% will not sound 5.5%. It will turn out to be around 4.8% or something like that. And that is why I'm saying that the inflation target in a properly measured context is 4 to 5%, and the band, tolerance band of 3 to 6% is a reasonable thing. If you exceed that band, nobody is going to hang you, but you cannot exceed that band for a long period of time, more than 3 quarters or something like that. I think that is a reasonable way of doing it. To come out of the inflation targeting right now will be disastrous, because unfortunately the market participants don't understand economics, sir. Had they understood the economics, this would not have been the case at all. I mean, you can't expect the dollar to become stronger. What is their economy? What is happening to the American economy and whatever surrounds the dollar? So nothing supports that. Nothing supports that. And you have exactly the opposite thing. We are facing the music in terms of the financial non-stability on account of the sharp depreciation. Sir, why? In fact, all the basic fundamentals show that our rupee is likely to appreciate in the longer run. And longer run is not very long run. It is going to be 3 to 4 years. Sir, is the market participants, are the market participants understanding any of these things? I have very serious questions on that, because market participants depend on doing the homework with the rating agencies, and rating agencies are not doing their homework. Let me tell you this.
Sir, I think the questions so far have been surrounding the main area which was announced. I would like to go a little further now. One of the aspects of financial stability as of now is the quality of reserves. As you know, India has about nearly 85% of reserves in dollar, Aussie dollar, yen, and euro. All of them are mouthpieces of dollar, if I can call it. They are not different. If US says, everybody will do whatever they want. Isn't it a huge risk in that sense that if US does what it has done, US and Europe, what they have done to Russia, they freeze our reserves, then what happens to us? There will be a huge instability. Of course,
go ahead.
Yeah, of course, Russia has now retaliated. If you freeze our 300 billion, I will freeze your 1 trillion of investments, private investments in Russia. And he has taken the measures and he has already got it passed, I think, through his whatever is a local forum of parliament. That is fantastic. But I think I'm going beyond a point which I had made in the opening remarks. Is dollar itself worth it? Will they be in a position to even raise enough dollars to repay their own maturing debts? In fact, I am told that they are even crawling at the feet of Venezuela now to supply them cheap oil. This is the development in the last 1 week to 10 days. So if that is the case, if US will find it difficult to raise that 2.5 or maybe even 3 trillion of deficits for their own use, what is going to be the future of dollar itself? That is my question. The entire 500 and 464 out of that, rather about 567 out of that 668 is, I'm counting out the SDRs, is in currencies. Is Reserve Bank doing anything about it and in a calibrated way so as to remove this disturbance? Is my question.
See, it's a good question. Your observations are reasonably valid. In fact, I would say that the dollar weaknesses are very clear. They are apparent and they are coming forth day by day. In fact, every day there is a new revelation about the weaknesses of the dollar and the American economy. I think there is some kind of a bite which is in circulation in the social media. Very many people must have watched that also. That there is a history and there are cycles about the dominance of a currency. Dollar has dominated the world currency for a long time, but now it is almost on the verge of completing its average period. That means that, and fortunately or unfortunately, the weaknesses have started coming out. I mean, just as in the past, other currencies were dominating the world, and their weaknesses came out, and they had to give way to the other currencies. Right now, also, dollar has the same kind of things coming out. And my clear cut, I mean, I fully agree with you that dollar has serious weaknesses. As far as the unilateral decisions of derecognizing the reserves and freezing the reserves, etc., I think with all the insanity that the American leadership is showing, I think this is far too insane thing to do, and I don't think that people will be doing that. Don't equate ourselves with Russia. We are very democratic. We are very different kind of country. It is not authoritarian in any sense of the term, and it is very difficult for anybody to freeze this kind of assets. It is impossible. As far as what RBI has been doing, if you want to see, please look at the things yourself. You will see that the gold reserves are slowly and gradually are rising. Obviously, they should rise because of the simple reason that there are uncertainties about dollar. But the unfortunate part is we cannot completely delink. We are trying to ensure, what RBI is also doing is, we are trying to ensure that rupee gets accepted as the medium of exchange in several other kind of trade relations. If that happens, automatically we are taking the necessary recourse. I think that is something which we need to keep in mind.
Sir, next is a question through the media from one Miss Malvika. Sir, I have a question. Given the uneven burden of inflation across diverse income groups and regions, how should monetary policies and fiscal policies be coordinated to mitigate distributional harms while also preserving macroeconomic stability?
Excellent. Please note that monetary policy is not expected to talk about the inequalities. You are referring essentially to the inequalities. The unequal burdens, which are supposedly shown through the differing inflation rates, that is a different ballgame altogether. But please understand and note, we have done some research on this, and I think Piketty has done a lot of research on this inequality question. And what we have found is, using his own data, using his own thing for the Indian economy over the period of time, we are showing that inequalities have nothing to do with the growth on one hand and inflation on the other hand. That means higher inflation leads to higher inequality is the wrong thing. Higher growth leads to higher inequality is the wrong thing. Higher growth leads to lower inequality, again is not supported. Higher inflation leading to lower inequality again is not supported. That means that inequality and inflation, inequality and growth are very different, distinct things. Now, please understand, monetary policy is not the means to address the inequality issues. Inequalities are better addressed directly by the fiscal policy. And that is what is being done of late. After 2022-23, in fact, after COVID, you find that the inequalities in India have sharply fallen because there is a lot of free food and other things which are being targetedly given. And this has worked. I think, so please understand that this differing inflation rate across different items is not the concern that can be handled effectively by the Reserve Bank of India or RBI for monetary policy. There is no way of doing it. There is no theoretical framework or no theoretical way.
Lokeshwarri ji, you had some question about the public debt and the instability it can create.
Yeah, but I thought I'll ask rather something on the exchange rate.
Okay, you
Change my
carry on, yeah.
mind, staying with the rupee and all that.
Yeah.
So you said that exchange rate is used to control the money supply in a theoretical format and so on. But rupee, if we see over the last 20 years, it's depreciating most of the time. Like annual average depreciation of rupee over 20 years is 5% annually. And last 10 years is 3.5%. It keeps falling. And last 10 years, only 1 year it is appreciated. And RBI stated policy is that it will only intervene to contain the volatility in the rupee. That's what they keep saying every time we ask them this question. So what exactly, is there some unstated kind of a policy that they are more comfortable with a depreciating rupee rather than appreciating rupee? Is there, or is it's happening because what you're saying, because of the problems in the way they're going about the monetary policy itself? Is the rupee depreciation an outcome of that?
No, it is not an outcome of the monetary policy at all. Because, right now the rupee is depreciating. I mean, it's a very surprising thing and very, in a way, inexplicable kind of a thing. Why is it depreciating? Just because of the expectations, nothing more than that. There are wrong things which are being emphasized by people in a wrong way. Like, say, for instance, there was a huge media coverage and everything regarding the Trump tariff. Now, what is the exact implication? What are the exact things? RBI itself has studied this question thoroughly. And what it talks about, it says that with all the things happening, the impact of Trump tariff will be hardly 20 basis point negative, okay, on the growth. On the other hand, the positive effect of the GST reforms, okay, will be in the range of 50 to 60 basis point. I mean, rather than emphasizing these matters, people are unduly focusing. Every day you start the TV, you start any other thing, and people talk about what the new dream that the Trump has seen after waking up in the morning. And it is only those news items which are, it is creating a sort of a panic. I don't know whether the market participants are intelligent enough to discount some of these kind of panics. I don't know.
Okay.
I start having doubts about the intelligence of some of our very big market players. Because, again, the market is in India, unfortunately, it is not a perfect market. It is far from perfect market. And you know that it can be manipulated. So I'm not too sure. I will not give credence to the short-run kind of fluctuations, because short-run fluctuations you cannot address by any policies. Policies are meant for long-term. Policies are meant for providing the guidance. Policies are meant to really provide a long-term path. I think the short-term fluctuations and short-term things are better left to the market.
So what are the basis on which you said rupee should appreciate in the next 3 to 4 years?
Because our growth rate has been phenomenal in spite of the fact, suppose 8.2% you don't believe, don't worry. 7% you believe, right? 7% versus 2%, you can see the difference. Now, this difference is largely in terms of productivity growth. So that means that our inflation rate of something in the range of 4.5%, right? And their inflation rate right now is around 3%. It is not 2% anymore. It is 3%. Now, what do you expect? You expect that, there should be an appreciation over a longer period by at least 3 to 4%. It doesn't happen because of various reasons. And people start focusing on the current account deficit, the imports growing faster, exports are lagging, and things like that. I think it is all a short-term phenomenon. It's all, we are managing at a different level. It is not RBI which is managing, it's the government which is managing. Because these are not in the hands of RBI to promote exports or to compete with the imports and promote the domestic production. These are not RBI matter at all.
Captain, next 2-3
Yes,
questions
we
from
have
the audience.
490 viewers. A number of questions come. We've got another 7-8 minutes, sir.
Yeah.
I'll try and question as many questions as possible. We
Yeah.
have a question for Ravi Kumar from Coimbatore. How should India's monetary policy framework evolve to better absorb the global shocks such as commodity price volatility, geopolitical uncertainties, and rapid financial tightening in advanced economies without compromising the growth momentums?
It is extremely difficult to compromise, not to compromise the growth momentum. If you want to not compromise the growth momentum, you will have to absorb these shocks by the market rather than do any positive, proactive things.
Good, sir. Next question from Mr. Francis from Hyderabad. He says, with gold price hitting record high and influencing the domestic markets, how should India view gold as a safe haven asset and driver of external sector pressures? Can monetary policy meaningfully address these fluctuations?
The gold prices fluctuations cannot be, any commodity for that matter, cannot be, a specific commodity prices are not in the realm of the RBI. RBI is supposed to be talking about the general price level, general commodities and other things. I think these are all the specific item-wise prices fluctuations, and that should be left to the market in a way. I think, again, I am telling you, if for the price of gold anything has to be done, it is by the government in the fiscal policy, not in the monetary policy. This is not the way.
Mr. Ravi, again from Chennai, he says, given the current inflation trajectory and the growth outlook, what key factors should guide future repo rate decisions? How does the RBI balance the trade-off between supporting growth and containing inflation?
Very good. I think because you are specifically asking for how does the RBI do all such things, where without divulging the further details, I can only broadly say that there is a very good framework which is available by the Taylor's rule. The Taylor's rule suggests that if the inflation is lower than the target, then the monetary policy needs to be more relaxed. It is an easy money policy. Similarly, if the growth rate is well above the trend rate or the potential rate of growth, then the monetary policy needs to be tightened. Unfortunately, there are controversies about what is the potential rate of growth. Rangarajan and many other economists, very, very serious and senior economists, have been talking about the potential rate of growth to be around 7.5% to 8% in India. I am no exception. I am also talking about that. But some statistical measures show that the potential rate of growth is around 6.8% to 7%. That is a statistical jugglery. It doesn't talk about the ground realities. The ground reality is that India has a potential rate of growth of around 8% without igniting the inflation.
The next question is from Mr. Murthy from Bangalore, sir. In what ways do increasing fiscal pressures, such as higher government borrowing or subsidies, limit the RBI monetary policy effectiveness? And how can better fiscal monetary coordination can be achieved?
Fiscal policies are the ones which are essentially, considering the subsidies and the tax issues, and that should really be left to them. The RBI is only supposed to follow the broader kind of framework where is the fiscal policy more accommodative and more easy, or is it a tight fiscal policy? I think the tight fiscal policy or the easy fiscal policy is to be seen in terms of the absolute, not relative, absolute fiscal deficits is a single kind of a parameter which is workable. It is not theoretically correct, but workable. So if there is a fiscal deficit which is larger than before, then it is a more relaxed policy. If the fiscal deficit is the lower in absolute terms, then it is a tighter fiscal policy. That is the
one last question. One last question to you, sir. Then there is also one question addressed to Mr. Kumaraswamy and also Lokeshwarri. The last question is, how important is stable foreign investment flow for maintaining rupee stability? What policy measures beyond monetary policy could support these objectives?
Very good question. In fact, what it says is how far the external flows are important for financial stabilities in the country where it is very high. Although on margin, the magnitude seems to be small as compared to the domestic economy. On margin, if you see, it is a very substantial flow. Therefore, if the inflows are very, very large, all of a sudden, you have the problem of domestic financial stability. And if the flows are very low, again, you have opposite kind of the problem of financial instability. To maintain a constant and consistent flow is important, therefore. Now, in order to do that, the RBI is typically talking in terms of its repo rate adjustment vis-a-vis the world, vis-a-vis the US and the other things. That what is their repo rate and what is our repo rate, because we should not provide a disincentive. Unfortunate part is that the interest rate parity has the country-specific risk factor, which is added. Say, for instance, if the US rate is 4% and our rate is 6%, 2% or maybe 2.5% becomes the risk factor for India. Can anybody explain to me what is the risk factor? And does it, does it justify a 2.5% type of a factor? Sir, are we that poor in terms of the economy? Is our stability not there? Is our performance not there? Then what is that? It is only because the rating agencies are giving us BBB and BBB plus. Whereas US, with all the blunders on earth, they get A, AA and things like that. Sir, why should that happen? Why should that happen? If it is a forward-looking thing, then look at the forward things. Sir, is there any possibility at all for the US debt to come down? On the other hand, India, the public debt, debt GDP ratio has been consistently coming down. After a hike during the COVID period was not within our control. But thereafter, it has been significantly coming down. So what is the future trajectory, sir? That is the reason why I'm a bit disappointed by the rating agencies on one hand and our own people interpreting those things on the other hand. And anyway, the foreign investors are very clear, sir. If they are the portfolio investors, they are the fair weather friends. If they are the FDI investors, the real investors, they are the ones whom we should really worry about. And my only concern is that we are offering the best kind of environment for any permanent friends, which means the FDI. This is the best destination right now in the world.
Excellent, sir. One last question, quick response from one Lokeshwarri, one for Kumaraswamy. Here a question from Sri Kumar to Lokeshwarri. Monetary policy decisions can become complex and technical. What role does a responsible financial journalism play in shaping public understanding and expectations around inflation, interest rates, and financial stability? That's what Professor Dholakia also mentioned about it. Go ahead, madam.
Yeah, I think it's up to us to really explain it in a simpler form that the common people can understand. I know that some of them is very complex, even we cannot understand. We try our best and listen to people like Dr. Dholakia to understand it, and we do our best. I have suggested to the RBI itself also that why can't they put out explainers, maybe in regional languages also, maybe do short videos. Because I think in the RBI, you have so many people who are so intelligent and you have a very good workforce. So, sir, maybe you can put it across to them, to even educate us or even train the media. RBI should be doing that. Yeah.
I'll take this suggestion very positively. I'll try to do something. Thank you.
Here's a question to Chairman Kumaraswamy, sir. From your experience observing communities across India, what behavioral or structural factor do you believe are underestimated in the current understanding of inflation and household financial stress?
I have no answer to this complicated question, but I would answer an analogous question. First of all, there is no monolithic inflation figure which is going to work for everybody. That's for sure. Inflation in Madurai will not be inflation in Chennai, and it will not be in Agra. That's for sure. So how it affects each different class is going to be further going to be very, very fragmented. In fact, I was to ask a professor one question about pensioners inflation index. In fact, you look at the pensioners like me, we have a roof overhead, so housing inflation doesn't really concern me. After work, I've stopped traveling. So, I mean, day-to-day travel to office, so no fuel inflation for me. Food nowadays, the second or the third, if any of the restaurants threaten a second or third roti, I run away from the table itself. That is, the consumption is more governed by need to control weight and, dieting, etc. The thing which is affected by inflation is only the medical expenses. So far, I have been, lucky there, but that will concern all this one. If one of the arguments given for high and low inflation is pensioners' interest versus employment or beginners, people looking for, jobs, is it not time to construct a pensioners index and use that as the basis? At least give a weightage. I'm not saying that 100% weightage should be given. Give a due weightage to that inflation as well as the headline inflation or the GDP deflator, if it has to be corrected, as the basis for monetary policy and fixation of the central targets, rather than currently, the 4%, the way it is justified, I am not very satisfied or convinced, but that's a matter for a different day. So that's the answer I can give at this stage to the rather complicated question for me here.
Thank you, sir. I think we have really run out of time, and thank you, Dholakia, for the outstanding, great insights. It's so inspiring. We are only feeling disappointed why we have come to the end of the program. We could have carried on for some more time to understand more. And also thank you, Mr. Kumaraswamy, for facilitating Mr. Dholakia to come and speak to MMA, and also for Lokeshwarri for joining us this evening. About 490 viewers have joined online. I got so many questions. We tried and picked up and put what you spoke and what is relevant. And since you are separated by the distance, what we could do is we would like to present a digital memento. So what we do, we present a memento on behalf of you. We go to the poor, we do a lot of CSR work in a number of schools. We give some books and some of the needy to the poor children. We give it on your behalf because people like you come and visit MMA. That's what add tremendous value to MMA. And thank you so much for accepting this honor. And we'll be making a presentation to the school on your behalf. These are some of the children, what we give to them, and we take care of them at different schools where very, very poor children study. And we also have a memento for Mr. Kumaraswamy and Lokeshwarri. Can I have the memento for Mr. Kumaraswamy and also for Lokeshwarri, please? We have a digital memento for Lokeshwarri. Yes. Showing the wrong picture.
No, we already seen that, Captain.
Yeah, this for Kumaraswamy, Lokeshwarri. Thank you. Thank you so much, sir. And thank you so much. Thanks once again. Thank you, viewers, for over 490 viewers. And it's a great number. I'm quite sure you can really pass on the message. If somebody want to really understand the monetary policy trilemma, yes, they log into the MMA website and they log into our YouTube channel and watched it. And thank you so much. Thanks once again to IMA alumni for joining us this evening. And also Mr. Kumaraswamy for again facilitating this great talk this evening. Over to you.
Thanks, Group Captain, for this joint program with IMA Chennai chapter.
Thanks, Professor, for coming and sharing your thoughts. So very outspoken as usual, forthright and very lucid. And thanks, Group Captain, for your facilitating this meeting, and Lokeshwarri ji for joining us in the panel. Thank you all so much and have a great evening.
Thank you. Thank you very much.
Thank you, Professor. Look forward to seeing you soon again in Chennai, Professor. Thank you.
Okay.
Bye-bye and good night.
Bye-bye.
Bye.
Good night, madam.
Bye.
Thank you.
Okay, Shankar. Bye-bye. Thank you. Good night.
Good night, sir.